Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about velocity banking again. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And then once you paid off your debt, you might experience something called rich people problems. Let me write that down for you. Rich people problems. And what is the difference between poor people problems and rich people problems? Well, there's a mindset shift that you have once you start to have rich people problems. And one of the things that you don't like once you start to become rich is savings accounts, right? Savings account. That's kind of like the ultimate rich people problem. So when you're poor, like you have problems, you don't have make enough money, you can't even go to sleep at night. But when you're rich, it's like, oh man, this is so annoying. I got too much money in my savings accounts. And we're going to teach you to think like the rich, which is not to save money. Okay. Once you start to have like 10 grand, 20 grand, 100 grand in your savings account, you start to feel that, ugh, like I had too much money there because I'm only getting like 1% interest and inflation is eating away my money and I need to grow it like 7 to 12 or something like that. Right. So that's the ultimate, rich people problems, which is saving money. But on the positive side, at least you can go to sleep at night, unlike when you have poor people problems. So I want you to think about how your life will be when you experience rich people problems. It's all a mindset shift. Okay, it's all a mindset shift. All right. And one of the rich people problems that I have was I simply just paid off my mortgage too quickly. I don't know if it's a problem. I guess it's not a problem, but I did pay off my mortgage way too quickly. And I did it by not saving money. I know shocking, right? Like it's very shocking. I didn't save money and then I paid off my mortgage quickly. So we're gonna go ahead and deep dive into velocity banking of how it's easy for us to not save money, pay off our debt quickly, and still maintain control of it. And I think that's the biggest fear that people have, especially when they want to pay off their loans. It's like, well, if I put an extra 200 or 400 bucks in my loan, I can't really get that money back. And then we're going to use something called a line of credit to help us figure that out. Okay. So, velocity banking, first step is a budget. Income, expenses, we have our leftover savings. Now, in this case, we have negative $2.21. Okay. And when we do our expense breakdown, we have to list every single debt that we have, three credit cards, an auto loan, and in this case, we'll have 2 student loans, right? I don't know if you've ever seen it in, like, your student loan statements, like, you just don't have 1 student loan usually. I got, like, 3. I remember I had, like, 3 of them, like, 2 federal and 1 private, I don't remember, but I remember I had, like, 3. And then we have a mortgage right here, okay? A mortgage, and then these are all of our debts, and then everything that's not a debt that we generally pay for, we put it in this little bucket called other food, gas, insurance. Okay. So, what we're going to do is we're going to answer the question, hey, if I want to get out of this negative savings hole, do I need to make more money? And most people would say yes. But when we're doing something called velocity banking, same income, same expenses. Whoopsie. What am I doing? Same income, same expenses. Okay. And we deliberately don't save money, okay? We deliberately don't save money with the help of something called a line of credit. Can we make this number go from negative to positive? Crazy, right? It's a different way of thinking. All right, so let's go ahead and also assume we have something access to something called a line of credit. So, what is a line of credit? Well, basically, it's a financial tool where you could borrow money, pay it back, and then use it over and over again. So, if you have a credit card, that's a line of credit, but they're more, I don't know if you would call it flexible, and I don't know if you call it better, but there are other types of lines of credit like personal or home equity, right? Because the biggest challenge that people have with credit cards is that they're somewhat inflexible. Like I can't use credit card 1 to pay credit card one's bill. But if you have a line of credit because you're actually dumping in cash into your checking account and you're being charged a much lower interest rate, oh man, it solves a lot of problems. Like this $280,000 line of credit that I have. In fact, I have over $594,000 in lines of credit. $594,000. Okay. $594,000 in lines of credit. And so, I don't even know, like, I'd lost my train of thought because I got rich people problems, you know what I mean? I got too much credit and sometimes I fail to remember how much exactly I have because I make various YouTube videos. I remember last year, I think it was last year or 2 years ago, I was making videos about how I have over $220,000 lines of credit. I got 594. Soon it's gonna be 1,000,000, right? Soon it's literally gonna be $1,000,000 in lines of credit. And the secret to getting lines of credit, and again, just memorize this, is that banks don't lend money to people who need it. I know if you've heard this for the first time, you're not going to understand it, but just repeat after me. Banks don't lend money to people who need it, and then you'll understand the secret of getting all this credit, 280,000. Okay. But in this instance, we're going to say we have access to a $75,000 line of credit at an 8% interest rate. Now, will a bank lend you a $75,000 free and clear line of credit when you're at -$2 in the hole? No. No, no, they won't. Because you know what that's like? That's like trying to get car insurance after you crash the car. Here you crash the car, but what if you had an insurance policy before you started driving? See how that works? Right? You would never even be here. So that's the real moral of the story, okay? That's the real moral of the story. The right? Now, in this case, this line of credit would be a lifesaver. It's just kind of like having car insurance before you crash the car. Don't get it after you crash the car, okay? All right. So, what we're going to do is move some debt into that line of credit, and we usually start off with either credit cards, high interest rate credit cards, or okay, or those buy now pay later loans. Folks, I have seen those buy now pay later loans advertised at like 0% interest, yet someone sent me their buy now pay later loan and the actual contract said 30%. I don't even know how that works, but that is insane. There's a reason why these buy now pay laters are like exploding all over and making a ton of money because people don't know how to manage their finances, right? Well, let's just do this. Let's go ahead and take these 3 huge credit cards, okay? And how much is it in total? It's $72,000 in credit card debt, right? So we're just simply doing a balance transfer. And guess what happens to these 3 payments? 0, 0, 0. Oh my goodness, did you catch that? 3 zeros, okay? And if we take a look here, we literally went from -$2.21 in our savings account to $2,390.29. You're shocked, aren't you? You're shocked, especially if this is the first time you've seen it. It's like, what? How'd that happen, right? Because, and the reason why I know most of you are shocked because I get so little comments on this channel. I get a lot of watch time, and I'll just take it as a compliment that all of you are studious and doing these spreadsheets on your own computers, even though a lot of you are watching from TV. But, but how do we go from -$2.21 to $2,390.29 without saving money, right? That's the secret. You don't save money and you use a line of credit to increase this thing called cash flow. And so the final step is once you get that paid $6,100 in your paycheck, you could be a couple doing this, right? Right? Maybe 50-50, 50,000 each. $6,000 is about like $100,000 a year. So you put your entire paycheck into that line, the 72,000, and it does two things. It satisfies the minimum monthly payment, and then number 2, it lowers the interest because it's based on the average daily balance, right? And then you take the money out of the line of credit. In fact, I actually like to use credit cards for this because when I use a credit card, as long as I pay off the statement balance in full, okay, I can essentially skip interest for a month. And then, I pay off a credit with a credit card, pay it at the very last possible moment and pull that money off out of my line of credit. But we're not going to talk about that today, but that's essentially what I would do. So paycheck in, expenses out, and of course we have to consider the cost of using the line of credit as our debt tool to consolidate debt. So 2390.29. So to get the next month's balance is based on the previous month's balance, previous month's interest, and then we subtract our cash flow. And then what we do is take the interest, get the average daily balance, like this is just a good estimate of the average daily balance, multiply by the interest rate, and then you divide it by 12 because it's monthly, right? So for a month one, we got to pay about $400 of interest. And then we see in 6 months, we pay about $70 less in interest, but our balance is going, whoopsie, where do we go? I went to the end of the spreadsheet, end of the line. All right. So let's go ahead and copy and paste this, right? And then we see, okay, that in 34 months, this was all paid off. 34 months. All right. Can you believe it? All right. 34 months to pay off 72K of debt. All right. So I'm going to copy and paste this. And then, all right. And then I'm just going to do this, which is at 34 months, 34, 34, 34, 34, figure out which debts to pay off, right? So this is a loan calculator right here. We got the auto loan, the 2 student loans, and the mortgage. Now, I know some of you are thinking, why don't we focus on this highest interest rate? Highest interest rate. And the reason why we don't necessarily focus on that, although that's a legitimate strategy, is we're just kind of focusing on our cash flow, right? And so here's the thing. There's this thing called the cash flow index, and it's kind of like a ranking system, okay? It's just a formula, the balance divided by the payment, and it gives you an arbitrary number. And the lower the number, that's the one you want to pay off because it gives you the most cash flow. So it's like pay off 9 grand to get $386 of cash flow in my life, or pay $7,699 to get $100 of cash flow in my life. See how that works? So I'm going to pay this one off, even though it's a lower interest rate, and get that $400 of about $400 of cash flow. So let's go ahead and do that and move the auto loan into the line of credit. Right, I'm going to move the auto loan here. So it's going to be plus 9616.67. And then guess what happens? Okay, this is going to be 0. And then now our cash flow is $2,777.04. Okay, so I'm going to go ahead and do this and increase our cash flows, which is going to be 2777.04. And then let's see how long it takes for us to pay it off. Okay, 38 months, not bad. 38 months. Look at the cost of the line of credit here. That was pretty small. Not that much. Okay. All right. So 38 months to pay off the auto loan. Okay. And let's go here. 38 months to pay off 72 plus 21, which is 93K. Okay. And so now, oopsie, I think I screwed up here. Did I screw up? Oh, you know what? I lowered the interest rate. It's okay, 5.5. All right, so now at 38 months, right? So this is 0, this is 38, this is 38, this is 38, right? Now we're going to go ahead and pay off this one right here, this student loan right here. Get an extra $100 in our cash flow. Now, here's the thing. When we're dealing with loans, right? There are a lot of people on the internet say, "Oh, the loan interest rate doesn't matter." It does matter, okay? Now, if there's no like if you have, let's say, an 8% mortgage, which does exist, right? Especially with investment properties, and you move into 8% line of credit, not a big deal. But if you have a 3% mortgage like right here, and you have this huge cash flow index number, meaning that if you move this $186,000 into a 8% or 9% or 10% line of credit, and all you're getting is $843 of cash flow back for that 186,000, you're going to end up paying a lot more than you have to, right? So the safest way to pay off any of these debts is using something called the chunking method, which is you're just going to move a small piece of the loan into the line of credit. Now, because this loan balance is so small, I'm okay with moving it into a line, right? So I'm just going to do this, and this is going to be 7,000 plus 7404.1.1. Okay, and look at that, 2 months it's completely paid off. Okay, and then this is going to be 0, and then what's our cash flow is 2885.56. All right, so now This is going to be 2885.56. Okay. So we just paid that sucker off in 2 months. All right. 40 months. And then that's 103K. All right. So now what we got to do is in 40 months figure out what the balance of this one is. 40, 40. So let's use this chunking thing with this 25 grand, meaning we just move about $7,000 into the line of credit and then just kind of rinse and repeat over and over again. In fact, let me open up my Velocity Banking Calculator. Give me one moment. All right, here we go with the Velocity Banking Calculator. All we got to do is just type in the details and then it will tell us, okay, what the payoff time is. So this is going to be a 10-year loan and this is going to be for 35,000, so 35,000 at 5%. And then this is going to be 25,211.43. 25,211.43. And then the payment amount is, what is the payment amount? Oh, wait, it's right here, 371.23. 371.23. And then the expenses is everything except for the loan we're trying to pay off, which is these two right here. So these two right here, so 2843.21. So 2843.21. And then it'll tell us the payoff time, 0.7 years. Whoop-de-doo. All right, so 0.7. So 40 plus 0.7 times 12, that's 49 months. Okay, 49 months. And then this is going to go to 0, right? And then that's going to be 138K. 138K. All right, so 49 months. This is going to be right here. And then 49. Actually, no, that's wrong. What am I doing? So now we just do the same thing with the mortgage, right? So the mortgage is now at 182,000. It's all paid off, and then we just simply put in the numbers right here, and then we'll just do a chunk amount of 6,500. And again, I always like to demonstrate with the 30-year mortgage that if there's not like a lot of cash flow from moving that loan into the line of credit, it's probably not a good idea, right? So let me go ahead and move it in here. So what's the original balance? The original balance is 200,000. 200,000. And I know what some people are saying, 3% mortgages don't exist anymore. No duh, but there's a ton of people who have them who got them 5 years ago, right? So all right, let's go ahead and A43 for 3.21. And then this is going to be $2,000 because it's everything except for the loan we're trying to pay off. And then what's the current balance of here? It is, are we at 49 months? Yeah, we're at 49 months. 182,133.09. 182,033. Is that it? 182,133. All right. I don't think it's going to make a big difference, but let's just do it anyways. All right. All right. Pay it off in 4 years. 30-year mortgage in 4 years. You know, if I didn't pay off mine in 2 years and 9 months, I think I might be impressed. See, that's how warped my frame of reference is, right? That's how you know you got the rich people problems. And then, okay, and then if we do this, so now this is 0. And then 49 divided by 12 plus 4, that's 8.08 years. And then we are debt free. And now here's the ultimate rich people problem. We don't have any more debt. And so after every single month, right, it's going to be an additional $4,100. And then now we're going to freak out because, like, oh my goodness, we're saving too much money. That's not good. It's being eaten up by inflation. So we got to get rid of it or not get rid of it, invest the money, right? After 3 months, you're going to have 12 grand because all your debt is gone, right? All of your debt is gone. And just to kind of emphasize that I am the goat of debt payoff, according to Meta AI, right? This is me, the goat of debt payoff. No, I'm just kidding. I don't know if I'm the greatest of all time, but according to ChatGPT, I did ask what percentage of mortgage payers does it put me in to pay off a mortgage in 2 years, 9 months? 1%. So I got the rich people problems. Rich people problems, okay? All right. Well, 4,100, right? 4,100, and then number 4 times 4. Well, what am I doing? Times 4. So, all right. Yep. Okay. All right. Well, that's it for today, folks. This is a Korean Atlanta mentorship. So hopefully you'll change your mind about savings accounts because here's the thing: poor people value savings, right? What when you're rich, you got debt, you don't want that savings, and when you're debt free, you don't want that savings either. See how it works? You don't want this. This is the ultimate rich people problem: having money in your savings account. Okay. Whereas when you're here, you're like, I need the savings, but why am I negative? Whereas remember here in this side, we're like, we're deliberately not saving money. Deliberately. Like this screenshot right here. Money comes in, it just goes out into the line of credit. It should say zero or close to zero, right? Remember, I talked to a banker once, and the banker said, hey, just put a penny in there because if you put zero, they think that you're going to close the account. It's like pre foreclosure status, but for a bank account, right? Right. All right. Well, that's it for today, folks. It's Korean Atlanta Mentorship. Have a great day. And also, just a quick plug, you might be thinking, where did I get this Velocity banking calculator? I got it from Renatus. So if you don't know what Renatus is, it's an online educational company and community. So if you want to learn this stuff and also other stuff related to some other stuff, called real estate investing and financial literacy, go ahead and click the Google form link below. Other than that, have a great day, and I'll see you all in the next video.